Howdy, Jacob here. Today we're looking at the Chemours company in the chemicals industry, 3.8 billion market cap on just under 7 billion enterprise value. So we're looking at a lot of net debt here. They provide performance chemicals globally. They operate through three segments: titanium technologies, thermal and specialized solutions, and advanced performance materials. Growth is actually negative over the last 10 years, but is a very cyclical business. You have revenue growth as high as 28% and as low as negative 17%. Return on invested capital, again, all over the place. It really depends on if it's a great year or not. So we're going to really be taking averages when it comes to our estimation of free cash flow and earnings. I think that's the most appropriate thing to do for a cyclical business as this. Gross margin, not very impressive, 20% operating margin, probably averaging out in the mid to upper single digits. Balance sheet shows 1.2 billion cash on hand, pretty much no short-term debt, but about 4 billion long-term debt. So the company is sitting on 4 billion long-term debt, and their production of free cash flow each year is roughly, even if we're generous, 400 million. So 400 million is about 10 times their long-term debt is about 10 times their the 400 million in free cash flow, which is a lot. This company is going to have to focus on debt reduction, and that's going to limit what they can do with the rest of their capital allocation. I mean, they do have 150 million going towards the dividend. It is a 4% yield, and I mean, it's just tough to get rid of those. And so I'll probably stick with that because it's not so much that it's really hindering them, but beyond that, I'm going to assume about 200 million plus goes towards debt reduction each year, which is going to very much hinder their free cash flow, or that's going to hinder their growth. And so they're already not growing much. I think I'm comfortable with that. They don't really have money for share repurchases as of now. So let's just do offset stock-based compensation. And then for margins, it's averaging about 6 and 7. This would be a company I want to get really cheap here because with their debt figure, I I don't like investing in companies with 10 times their 5-year free cash flow in debt. For me, I would need to make sure that that debt is due in the long run. I need to make sure that they can increase their free cash flow to be able to reduce that debt. And with 10 times, with declining free cash flow, with flat revenue over the last 10 years, I'm just not confident in it. And so 46% drop before you get the return I'm looking for here, but I think I'd wait a bit longer even still. But I do hope you enjoy the video and have a great rest of your day. Thank you.